Welcome to Copper's latest opening bell report. In this episode, we're diving deep into the fascinating relationship between Bitcoin's price movements and global liquidity. Plus, we'll touch on Ethereum's recent technical challenges and what they mean for its future. Let's get started. So, let's talk about Bitcoin and its intriguing connection with the M2 Global Liquidity Index. For those unfamiliar, M2 refers to the total liquid money supply, cash, deposits, and other easily convertible assets. Historically, Bitcoin's price has shown a strong correlation with changes in global liquidity. In fact, since 2015, this correlation has averaged an impressive 0.82. But here's where it gets even more interesting. Bitcoin's price typically lags behind changes in M2 by 10 to 14 weeks. In the most recent cycle, for example, M2 bottomed out on June 26, 2024, peaked on October 1st, and Bitcoin followed suit about 100 days later on January 9th, 2025. Now, in the current cycle, M2 hit its bottom on January 10th of this year. If history repeats itself, we could see Bitcoin trading sideways until late March or even late April before making its next big move. But here's a word of caution. This metric isn't foolproof. For Bitcoin to sustain any upward trend tied to M2 expansion, global liquidity needs to keep growing. If that doesn't happen, we might not see the same bullish momentum. If this pattern holds true, Bitcoin could peak somewhere around May or June this year, aligning with previous assessments made by Copper in our recent opening bell reports, suggesting a potential price target of $160,000 when markets start overheating. Backing this up are several indicators like market cap versus realized market cap studies and Bitcoin price simulations. Even sentiment tools like the Fear and Greed Forward returns are pointing toward a bullish scenario. Now let's shift gears to Ethereum for a moment. Thursday the 13th of March marked the 5-year anniversary of Black Thursday, a day many crypto veterans remember all too well, and Ethereum found itself at a critical technical juncture. It briefly dipped below a long-standing trendline, but managed to recover by the day's close. The big question now is whether Ethereum can hold this level. While it didn't hit a new all-time high during the last bull market cycle of 2024 to 2025, there's an interesting data point worth mentioning. Both Bitcoin and Ethereum have delivered identical compounded annual growth rates, 83%, from their March 2020 lows to today. On a closing price basis, Bitcoin edges out slightly with a CAGR of 70%, just 1% higher than Ethereum's. But these similarities highlight how closely these two assets are evolving over time. Now let's zoom out to look at the bigger picture. The S&P 500 is currently in correction territory, a situation that often signals a turning point for broader markets. Historical data from 2020 suggests we might be approaching another inflection point for both equities and crypto. From a modern portfolio theory perspective, Bitcoin continues to shine as an asset class despite its volatility. With an annualized volatility of 70%, a risk-free rate of around 4%, and a low correlation of just 0.25 with the S&P 500, an optimal portfolio allocation would include about 18% in Bitcoin to maximize returns relative to risk. And speaking of risk-reward ratios, here's something striking. Over the past 5 years, the S&P has delivered a CAGR of about 20%. Compare that to crypto assets like Bitcoin and Ethereum with their much higher returns. It's no wonder institutional investors are increasingly paying attention. Before we wrap up, let's touch on some broader economic factors that could shape crypto markets in the coming weeks. Inflation numbers have been remarkably positive this week, and geopolitical tensions seem to be stabilizing, for now at least. But as always in this space, there's an element of unpredictability. These macroeconomic shifts will undoubtedly play into how liquidity flows into or out of risk assets like Bitcoin and Ethereum. Thanks for tuning in. For more detailed information, feel free to download our report.